Today we'll be talking about the tools of monetary policy, how the Federal Reserve changes money supply in an economy with both limited reserves and ample reserves. So maybe you have a sheet of paper like this. On the front, it says monetary policy tools with an economy with limited reserves. And on the back, we have the same type of scenario, monetary policy, this time with ample reserves. So let me quickly uh, distinguish the difference between limited reserves and ample reserves. So, an economy with limited reserves describes how the economy was for the United States before 2008. The financial crisis of 2008 kind of changed how the Federal Reserve does monetary policy for now. But before 2008, we had a limited amount of money, a much smaller amount of money in circulation. And so we describe that now as an economy with limited reserves. So where you can change the supply of money and it has a direct impact on interest rates and therefore aggregate demand, because we know when interest rates change, the price of a loan changes and aggregate demand changes as people take out more or less loans. But post 2008, we now have an economy in the United States that we classify as ample reserves. The word ample means like a whole lot, a bunch. And so this describes how the United States is now. So there's so much money now in circulation that changing the amount of money really doesn't have an impact on the interest rate. So think about it like this. I always make the analogy of like you have a cup of water. You have a cup of water, and that represents an economy with limited reserves. There's, that much water that can be in a cup. And if you add, a couple tablespoons of water, you will probably see a difference in the level of the water. It could go up, or if you take the water out, it could go down. And so, changing how much water, how much money supply is in the economy, really has an impact on the level. But ample reserves, what we have now, is like having an Olympic sized swimming pool full of water. That's how much money is in circulation today. And so adding or subtracting a couple tablespoons from that amount of water is really not going to make that big of a difference or any difference at all on the level of the water in the swimming pool. So that's why changing money supply now with ample reserves doesn't really do the same impact that it used to. So, since changing money supply doesn't work in an economy with ample reserves, they have to change aggregate demand and interest rates in another way. So, today we're going to be talking about the limited way. So, we're going to talk about the old school way of how monetary policy used to be done in the United States and how it's still done in the majority of countries around the world that still have limited reserves. We done messed up in 2008. And so, the United States is a little bit different now. But let's talk about how it used to be before 2008. So, here we have our tools with limited reserves. And this is the things that the Federal Reserve has control over that regulates money supply. So at the bottom, I have a little T chart here, but it's kind of like represented in the expansionary and contractionary policies off to the side of this little chart, this little table here. So expansionary policy, just like with fiscal policy, the word expansionary increases aggregate demand and the word contractionary decreases aggregate demand. So essentially, you should use expansionary policy in a recession to boost spending. And in a period of inflation, you should use contractionary policy to reduce spending. So let's talk about how they do that. The very first tool, so that's going to be in this very first box here. The very first tool is the use of open market operations, which is another way to say, the buying and selling of bonds. It's also called OMO. So open market operations, the buying and selling of bonds, those all mean the same thing. So the central bank, which is the Federal Reserve, either buys or sells bonds to commercial banks. And that is how they can change money supply. So the definition is the buying and selling of bonds to and from commercial banks. But how it works, how to expand the economy is the Federal Reserve cannot just hand cash to commercial banks to get them to loan money. Like they can't just like hand over cash and say, here, take this. They have to give them money in exchange for something. There has to be some sort of transaction. They can't just give them money. So a bond, which is kind of like a loan, it's like an IOU, People can buy bonds. You can buy corporate bonds or state bonds or federal bonds, and banks can buy them as well from the Federal Reserve. That's who we buy them from. Um, uh, but they themselves, bonds are not money, but can be exchanged for money. So, like, um, let's say I'm Tomball ISD and I want to raise money to build a new stadium or something. Tomball can sell Tomball bonds in a way to raise money. So someone, a local community member, buys a Tomball bond, essentially giving money to Tomball ISD in exchange for a piece of paper that says, "Hey, I owe you money. I owe you money plus interest." So it's a way for like a person to give an entity like Tom ISD a loan without having to go through a bank. So because Tom ISD is going to have to pay that bond back, they're going to have to pay for the money that was given to them with interest. So why Tomball would do it is to raise money without taking out a loan. But why people would do it is it's a pretty safe. The only way you get your money back with interest. So it's an investment, but the only way that you don't get your money back is if the entity that you got the bond from like goes under, like Tomball ISD or Tomball itself is not going to go under, but if they do, so there is some risk involved getting a bond, but it's essentially a loan that you give to somebody and then they're going to pay you back with interest. So um, let's say it's a recession and the Fed wants commercial banks to loan out money. Well, maybe previously these commercial banks like Wells Fargo, Bank of America, whatever, um, they had they had purchased bonds as a way to store their money and earn interest. Well, now the Federal Reserve can buy those bonds back from these commercial banks and give them money for it. So, like the Federal Reserve will come into a commercial bank and say, "I'm going to buy these bonds from you, and I'm going to give you money plus interest for them." So that way, the bank can now loan out money because they can't loan out bonds because bonds are not money; it's an investment. It's different, but they can loan out cash. And if the Fed buys bonds. And so here can I draw? So to expand the economy with that first tool, the Fed will buy bonds from these commercial banks. And that puts more money in circulation because they're buying up all the bonds and replacing it with money that previously was not there. In the reverse, to contract the economy, the Federal Reserve will sell bonds to commercial banks. Commercial banks will have all this money in their like vaults, and the Federal Reserve will say, "Hi, I'm going to sell you this bond. I'm going to take some of that money from you for the purchase of that bond. I'm going to sell it to you, take the money, lock it away, take it out of circulation, and instead replace it with a bond, which they cannot loan out." So to expand the economy, the Fed will buy bonds, but to contract the economy, the Fed will just do the opposite. They will sell bonds. They will sell bonds to commercial banks, taking money out of circulation from these banks and putting it back at the Fed. Okay. The second tool of monetary policy with limited reserves. I don't want to. I need that. Here we go. Is changing the required reserve ratio. So in the second box for tools of monetary policy with limited reserves is the required reserve ratio, or RRR for short. So the required reserve ratio is the percent of deposits that commercial banks have to keep on hand. It's money that is deposited at a bank that they have to keep in their vault. They cannot loan this money out. It has to be kept in reserves. So you know, they do this just to make sure that banks have some sort of money on hand at all time in case there's like a bank run or a bank panic. There's always some amount of money in the vault just for a rainy day. And the Federal Reserve controls how much money actually needs to be in that vault. And so it's not a certain dollar amount, it's a certain percentage. So bigger banks might have 10% of their deposits kept in reserves. And another bank that's a much smaller bank might also have 10%, but that might be a different number depending on how big of a bank that is. And so Let's say that the number is 10%, but I want banks to loan out more money. I want the economy to start going again. I want to expand the economy. So then I will lessen the fraction of money, the percent of deposits that must be kept in reserves. So I will decrease the RRR to expand the economy because that keeps less money in the vault and frees up more money for loans. If they make that percent smaller from 10% to 5%, now it frees up that other 5% that I could use for like a business loan or something. And so to expand the economy, the Federal Reserve will lower the required reserve ratio, the RRR. It keeps less money in the vault and frees up more money for loans if you lower that percentage. But if you want to contract the economy, slow the economy down, then you are going to raise the RRR. Instead of 10% that must be kept in the bank at all times, maybe it's 20% that has to be kept in the bank at all time. That way you're keeping more money in the vault and you're loaning out less and therefore contracting the economy. Oh, just to let you know, oops, there we go. The synonyms, and this pops up every once in a while on like a test question. A synonym for expansionary monetary policy is easy money, and then a synonym for contractionary monetary policy is also known as tight money. So if you see those two terms, they mean expansionary and contractionary. Okay, going back to our very third tool, very last tool of how they did monetary policy before 2008 is changing the discount rate. So the discount rate is the name of the interest rate that if a bank was to borrow money from the Federal Reserve, the interest rate that they would be charged by the Fed is called the discount rate. So the Federal Reserve is kind of like the daddy bank, the daddy of all banks. And so I always think like daddy discount rate from the daddy bank. So it's the interest rate that the central bank charges for loans. So if I'm a bank that needs to take out a loan, I'm running out of cash myself or whatever, I'm probably going to go to another bank down the street, maybe a bigger bank in my town. Banks take out loans from each other all the time. But let's say for whatever reason that they all turn me down. Well, as a lender of last resort, the Fed does loan to commercial banks. They do loan money. And just like if we were to take out a loan, we have to pay interest. If a bank takes out a loan from the Fed, they have to pay interest rates too. So if the Federal Reserve wants to expand the economy, get more money flowing, more spending, well, they're going to make it cheaper to take out a loan from them as well to make it easier for banks to take out more loans and loan out to you guys. And so to expand the economy with the discount rate, the Fed is going to lower the discount rate, making it cheaper to take out a loan. So the name of the interest is called discount rate, or DR for short. And so they're going to make it cheaper to expand the economy to take out a loan. But if you want to contract the economy, then they're going to raise the discount rate, make it more expensive to take out a loan, and therefore less loans, less spending, hopefully less inflation as well. So those are the three things that the Federal Reserve can do pre-2008 in the United States. This is how they do monetary policy in the rest of the world, still to this day. But we don't do monetary policy like this because we now have ample reserves. But back when we had limited reserves, these are the three tools that would be used. Open market operations was the primary tool. That's the tool that they use the most. Reserve requirement ratio was the tool that they use second most. And the tool that they rarely use was the discount rate, because honestly, changing the discount rate, very few banks are borrowing from the Fed. So changing that interest rate is like, doesn't really have an impact, really, because that's like changing the speed limit on a road that no one drives. It's like, wow, you've changed no one's behavior because no one even drives on that road. It's like borrowing from the Fed. No one really does that. So changing that interest rate really doesn't have an impact on money supply. We're going to talk about these two graphs later, the money market graph and the reserve market graph. But all three of these tools, open market operations, required reserve ratio, and the discount rate, have an impact on both the money market graph and the reserve market graph. Okay, so that's for limited reserves. Come back to hear more about ample reserves later. Bye.